Welcome. I'm Keith Albritton alongside Justin Lee.
Yeah, I'm excited to be here. It's going to be good.
Kind of get to know us and who we are, how we do business. We're going to talk all things mortgage. We're going to try to cover everything, Justin. So,
Loans for homes.
Loans for homes.
And good afternoon, and welcome to episode 4 of the Loans for Homes show. Justin, happy Friday.
Happy Friday. Good to be here.
Yeah, it is good to be here, man. Thanks for joining us, guys. I hope you've tuned in the previous 3 episodes. Hopefully, if you did, you've learned something. And our point and goal each week, is to educate the audience and just kind of convey some of the things that we've learned over our tenure as mortgage originators.
Yeah, we keep learning every day. They keep throwing curveballs at us, and it keeps changing.
Keeps changing every day. It's hard to keep up. So today, we want to dive into down payment. And misconceptions. And I guess the biggest one we get every day, Justin, do you need 20% down to buy a house?
You don't need 20% down, and we're going to...
Really?
No, there's other ways to get you there.
Unbelievable. I never knew that.
Yeah.
So guys, you can put down as much as you want, or there are programs, believe it or not, if you qualify for them, with no money down. There are some, Justin, with only 3% down, 3.5% down, 5% down,
Yep.
so on and so forth.
Correct. If you're a veteran like Mr. Albritton here, you can do 0 down, 100% financing, and maybe get the seller to pay your closing costs if you got a good agent.
VA is a great tool. And in addition to VA, we have USDA, as long as you're buying in a designated area for, that's through the Department of Agriculture, USDA loans. And then there's THDA. We've got some grant programs through the state that are available.
Yeah, the housing fund, and there's a few other type of DPA type programs that help get you there and piece the down payment to 100%.
Yeah, and understand anything other than VA that is 100% or down payment assistance typically has an income limitation. They don't want somebody, a household income of $250,000, $300,000 a year, being able to buy a home with nothing down.
Unless you're in a
there's
position...
a call. Must be, somebody's wanting to know about these programs right now.
That was quick.
That was quick. So we'll get back to this customer here in a minute. But income limitations, and it depends on the county you're buying in, the size of your family. There's a few factors that go into that. So not everybody can qualify for the no down payment program. And the no down payment programs, Justin, are for properties that you plan to live in. You cannot buy a second home or investment property with no money down.
Correct. And there are some specialty programs like physician loans, for example, that if you are making over the income limit, we can still get you that 100%. But for the most part, it is a DPA type program that we're looking at to piece together.
Yeah, and you made a good point. Physician loans, in a lot of cases, guys, that covers dentists, it covers veterinarians. You do have to be a medical. You cannot be or have your license. You have to have your license at the time. You can't be still trying to get, in medical school currently. So you have to have graduated, received your degree and your credentials in order to do that. And those programs, Justin, go up to $1 million or sometimes even over $1 million.
Yeah, sometimes 1.5 million. It just depends. So
yeah, good programs. So talk to us, Justin, a little bit about maybe a DPA or down payment assistance program, what that means. And the phone is just ringing off the hook. I tell you,
it's a good day. Rates must be down or something.
It is a good deal. So, yeah, if you can just maybe touch on that, like what down payment assistance is and how that maybe affects people.
So if you're in the income bracket that falls in for your county that you make, the median income or less so that you can qualify for the DPA, we would do either a conventional first mortgage or maybe an FHA first mortgage where you're putting 3.5% down or 3% down. And the DPA would come in behind that and essentially gift you the difference in equity for the down payment. So you might still need to come up with a closing cost if the seller's not paying closing cost. If it's the housing fund, you might need 1% of your own funds, but it's going to help make up that gap to get you in the home for less money down.
And sometimes that could be in the form of a second mortgage.
Correct.
Right? That you either have to pay back or may not have to pay back over time.
Correct. It's tied to title, so there is a record of it being there. So it's not truly a gift that disappears, but it helps you piece together the gap.
Right. And there's a misconception out there too. Justin, there are things out there through Fannie Mae and Freddie Mac called LLPAs or loan level pricing adjustments. And, again, the misconception is on that piece of things is, hey, I get the best rate by putting 20% down. And that's not the case. Fannie and Freddie actually penalize people. I mean, that seems to be, there's a pretty big hit for that depending on your credit score and when you're making a down payment of 20% versus somebody that's putting 3 or 5% down, and those programs can get a better rate in some cases.
Right, up until 2 years ago, 20% was kind of the sweet spot for getting the best rate in term, but it's just not true anymore. Sometimes you get a better gap at 10% down or 5% down, and you do have mortgage insurance, but it doesn't have to always be monthly. Sometimes you can just single premium financed, and it might only be $2,000 or $3,000 financed into your loan amount.
Yeah, good point. And guys, mortgage insurance, I mean, most of you probably know what mortgage insurance is. Maybe you don't. Mortgage insurance insures the lender against default on the loan. So that comes into play anytime you don't put 20% down. So it's a riskier loan. If you've got 20% in the deal, you're probably less likely to walk away, Justin, from that that home that you just put 20% down on, versus someone who didn't. So mortgage insurance is required, and there's 2 or 3 ways you can pay mortgage insurance. It doesn't benefit you as the buyer. It protects the lender against default. But the tried and true way is to just pay it monthly.
Correct.
Right, every month. And another option is to do it a single premium, where you pay one premium up front and you don't pay any monthly fee. You do it one time and you're done.
Correct.
Right? There's another way called financed mortgage insurance, where you finance it into the loan. If you've got enough room in your loan to value, you can finance that in. And lastly, there's something called lender paid mortgage insurance. Boy, that sounds good, right? My lender's going to pay it.
It's a gift.
There's a catch. There's going to be an increased interest rate. We've got to finance that into the equation somehow. So we're going to do a single premium. Let's say it's $3,000 to pay it up front. Well, we're going to make sure that we bump the rate enough to cover the cost of that $3,000 that we just paid on your behalf. It may be better for you long term.
Right.
And that's something we're happy to talk to you about, certainly. But that's kind of what mortgage insurance is in a nutshell.
And it also protects the lender, because if you've got 20% equity in your home and there's fluctuation in values over time, most likely the value is never going to drop 20%. Right. So if the lender had to sell your home and foreclose, they would have the equity there and not lose any money as far as the principal of the loan. But when you're putting less down, there's less cushion there for the fluctuation in home values.
Yeah, absolutely.
So the mortgage insurance insures us as the lender there so that we're protected.
Very good point. And that's important too, because lenders look at that, because we don't know what's going to happen to values. We hope that it's always going to go up right after we make a purchase. And sometimes, or not always, is that the case?
Correct. Sometimes things change, and unfortunately the economy changes.
Yeah, exactly. But if you've got questions, obviously call us at any time. We told you that regarding down payments and things that are available to you, that sort of thing. So in addition, Justin, to down payment, we want to talk a little bit about different types of income that people have.
Well, also for the asset piece and down payment, we also need to know where it's coming from, right? So
Great point.
It's not just like, hey, I've got $100,000, I'm putting it down, but you don't need to know where it's coming from. Unfortunately, we've got to source that. It's got to be in your bank account. If you've got large deposits coming in, we're going to have to ask some questions and either show it as a gift or show that it's from a qualified source. So we've got to see that money trail to get it to closing.
Yeah, I mean, there's a lot of reasons for that, right? I mean, money laundering is one in the marketplace, but also they want to make sure you didn't go out to one of these fly-by-night lenders that will loan you, $10,000 on your car, unsecured or whatever it may be, and borrowing that $10,000 just created a payment of $500 a month for you, and now you don't qualify for the loan. So again, and we get this all the time. I mean, you can certainly get a gift from a relative to help you out with the down payment. But we've got to know, we get parents a lot of times that get a little sensitive and say, hey, that's not your business, but unfortunately it is.
Correct.
Even though they're not involved in the transaction, they somewhat are because they're giving a gift. But we've got to source where that comes from. And the easiest thing is to not have the donor give you the gift and put it in your account. So if you're going to be getting a gift, talk to your loan officer first so we can walk you through the steps of that and how to do it properly, to save you some headaches out there and to make it easier on you guys when we're processing a loan.
Right, like everything we've talked about up until now, plan ahead and get us involved in the conversation early.
Yeah, and just real quick too, gift funds typically cannot be used on anything other than a primary residence. If you're doing a second home or investment property, typically gift funds are not allowed. You do have to we've got to show that you've got the money to actually bring for those things. Interest or investment property and second homes also require higher down payment because they're riskier, Justin, than a primary residence. If something happens financially to you, it's a lot easier to let go of a second home or a vacation home or an investment property than your primary residence that you live in every day.
Right. The rule of thumb is that you're kind of going to stick and hold on to your primary residence the longest. So that's why you get the better rate in terms of that compared to an investment property.
Right. Exactly. Yeah. Talking about income, I mean, there's the old tried and true way you're paid hourly, right? You receive an hourly rate of pay. And in that regard, are you part-time? Are you full-time? If you're part-time, underwriters want to see a 2-year history of receiving part-time income because it's considered variable income. You may work 30 hours this week. Next week, you may work 20 hours. Then you may work 40 hours. So we want to see consistency. So what they're going to do is average that income over either 12 months or 24 months to see what that average income is going to look like. Now, if you're full-time and you're 40 hours per week, great, right? We can use that. You're considered full-time. And you don't have to have a 2-year history of working at the same company. We just have to have a 2-year history of work overall. So it's fine if you go from one company to another, hourly to hourly, as long as you're full-time. So don't go full-time to part-time. One area that I see most of this, Justin, is when you have a nurse that's been full-time.
That's what I was going to say.
And they go PRN, right? So they're like, oh man, I've been in the same line of work for 10 years and, well, you've just gone part-time. So, PRNs work, my wife's a PRN.
Right.
And they work different hours depending on the week, right?
Or they
when
go
they're
from
needed.
night shift to day shift, and they don't get that night differential anymore. That shift, it changes
right.
things,
And I've
right?
seen that firsthand over and over again. So keep that in mind. Now, if you are on a salary, easy stuff right there. We know what your income is. You can work 100 hours a week. You're still going to get the same rate of pay. You're always going to get that same rate of pay.
Right.
So that's the most consistent source of income, right? It is what it is. So going from a W-2 or salary position to another salary position is totally fine. And we love that because it makes it easier on you guys. One thing, Justin, that's a misconception is somebody may have 2 jobs. They've got 2 sources of income coming in. Can I use that? If I've got 2 jobs and I just started working 2 jobs, can I use 2
Not
jobs?
if you just started working 2 jobs so that you can qualify to buy a house. We need to see a history of at least 12 to 24 months of you working 2 jobs.
Yeah, and typically they lean more on the side of caution, and they want to see that 2-year history with
Right.
no gaps in it, right? They want to see that you work 2 jobs, because most people don't work 2 jobs, let's be honest.
Not for a long period
Right,
of
not
time
for a
because
long
you're going to
period.
burn out.
And they want to see, look, if you've been doing it for 2 years, you're probably going to stick with it. So, okay, if that's the case, you've been doing it 2 years, yes, we can use income from 2 different sources in that regard. So just keep that in mind. And Justin, our favorite, self-employed borrowers.
Yeah, we got a lot of that in Davidson, Williamson County, and Middle Tennessee. A ton of people are self-employed.
Yeah, we do. And if you're self-employed out there, guys, you know what that looks like, right? You're going to take advantage of the tax breaks that are being given to you through the IRS, through the government channels. So what we look at in your self-employed, of course, you're going to have gross income or gross receipts coming in, and then you're going to start, or your CPA is going to start taking allowed deductions, right? You're reducing that taxable income down to a manageable level. So let's say that you brought in $200,000, Justin, in whatever business you do, right? Let's say you're a window washer. You made $200,000, and then you had $150,000 in expenses that you're allowed to take, and now your taxable income is $50,000. That's the income that you're going to report to the IRS. It's your net income. You're going to pay taxes on that. Well, guess what?
That 50 grand is what we're going to use in income to qualify you on the new loan.
That's what we've got to use, not the gross income. Taxable income. And there's things that we can add back. We can add back things like depreciation if you have any, business mileage. There's a few things that we can add back to that as income. But that becomes a challenge sometimes for self-employed borrowers, right?
Right, it does. But I mean, that's why you want to talk with somebody like us instead of your regular banker, because we've got options for that. We might look at a bank statement loan or an asset loan. We'll find a way to make it work, but we need to have those conversations early.
Yeah, and I'll tell you what, bank statement loans are huge. And guys, this was created for self-employed borrowers. They know that people write off their income, right? That they take those deductions that are allowed by the federal government. So what a bank statement loan does is that maybe your deposits are going into your personal account, maybe they're going into your business account. Well, whatever account that goes in, we're going to get the last 12 or 24 months of the personal or business bank statement.
Right.
And we're going to look at those deposits, and we're going to give you credit for those deposits. It can't be, we've got to be able to source the deposits about where they came from, right? It can't just be a check from Aunt Jenny for $20,000 and now that's income.
Right.
We got to see that it was something derived from the work that you do.
It's got to make sense, right? It's got to
make
be
sense.
something that's going to continue, that it's income related.
Yeah, and we're simply going to take, your May bank statement. Oh, you had 9,000 deposits, and then we're going to look at your June, your July, and so on and so forth for 12 consecutive months. We're going to add up all the deposits
Take an expense ratio, and
Take an
that'll be your income.
expense ratio. Yeah, so an expense ratio is, guys, because we don't have an expense ratio from your CPA, we're going to take 50%. So whatever your deposits total up to be, we're going to take 50% of that overall income, and that's what we're going to use. And in most all cases, that's a lot more income than what you would have on your tax return to
Correct.
qualify for.
Most likely, we can still make that deal work. So we just got to take a look at it and average it over 12 months.
Yeah, exactly. Or let's say that you don't want to share your bank statements. Great, but you've got plenty of assets. Well, we've got an asset program, Justin. We use assets for income.
Correct.
And that works. There's all kinds of tools we can use. There's one that's got a lump sum. There's some we take all the assets and divide it by 84 months, and that's your income. But there's a tool almost for everyone out there, right? If you've got the credit, you've got the documentation, there's a way to
You
figure
got the
these
down
things
payment,
out.
you got the assets.
Yeah, right. And we can paper trail everything. So just keep in mind, guys, everything is a paper trail. And the companies that we and everybody in the mortgage industry get the money from, they're making the rules, right? So if you were loaning your money out today, and we're talking about $400,000 or $500,000, sometimes $1 million, we're talking about a lot of money. I'm sure you all would want to make sure that you're going to get paid back, don't you think? If you loaned out $200,000, Justin, are you going to want to make sure you get it paid back?
Yeah, I want to know that you're going to be able to pay me
So
back.
you're going to want to know more about that person that you loaned it to, I'm assuming.
Correct.
And that they have the means to pay it back, right? You're just not going to willy-nilly say, hey, here's 200 grand, right? So guys, we're going to know a lot about you. And it's not because we're picking on you. It's just part of the process.
Right.
So, the bank or the investor that we're selling that loan to, they want to make sure, again, that you can pay that loan back. And the only way we can do that is through documentation.
And we've got to play by their rules, and everyone's a little bit different. But in general, I mean, they're going to be looking at you, getting really close with you for the last 2 years.
Yeah, and I always tell everybody, I say, it's kind of funny. We get everything except short of blood and urine, and sometimes we may even ask for that. No, I'm kidding. We're never going to ask for blood and urine. I don't think so. I haven't had to do that yet.
Not yet.
Okay, good. Hopefully it doesn't come to that. What else? What else we got product-wise, man? We could go on for days and dive into what products that are available to us. I mean, there's some out there that we don't even know about.
Right.
And products change every day depending on the appetite for the particular investor. And I think, Justin, we're up to like 27 investors total now.
Oh, at least.
At rate. So, man, we're shop for the best rate. We shop for the best product for our clients.
If it can be done, we're going to get it done, and we're going to fight to get you the best deal.
Absolutely. And if we're not able to do something, guys, and somebody else is, maybe they're smarter than us, but in 9 times out of 10, they either know something we don't through the process,
Or they're not asking the right questions.
or they're not doing things on the up and up. And
Right.
we've seen that before when somebody comes back and we know we've gone through a file ad nauseum and we said it cannot be done, and they go somewhere and get it done. We have to wonder, oh my gosh, what is that person doing to get this loan done?
Right.
So just be cognizant of that, guys. But again, we encourage you to call us each and every week with these types of questions. And everybody has questions. I have questions.
Right.
Right. If you don't do this every day, it's hard to know.
Correct. Pick up the phone, call us. We're happy to chat about it. We answer the phone 100 times a day, so give us a shout.
They can't call you unless they know your number.
865-406-8486.
Yeah, and for me, 615-347-0578. You can find me at heathallbritton.com as well online. And what about you, Justin?
You're going to have to look at me up at the Guaranteed Rate website. So
Sounds good, guys. Let us know. Thanks for joining. And hey, next week we're going to be live from
Mexico.
Punta de Mita outside of Puerto Vallarta.
Correct.
So thanks to all of our referral partners out there. Justin and I were lucky enough to win the President's Club trip, which we have the last 3 years here. And so we'll be in Mexico next week. Tune in. We've got a special surprise for you next week, and we're going to talk good content.
Yep. Tune in next week. Y'all have a great weekend.
We'll see you from Mexico.
Adios.